Short-form videoization, assessing the potential ceiling and lessons from China. So this is an equity research report published by Goldman Sachs sometime last month. So for the weak-hearted Alibaba investors out there, let me give you a heads up first. It's going to be a tough report to sit through, so brace yourself. If you want access to the full report, I'll leave the link in the description. Side note, people on Wall Street are collecting CFA and CAIA titles like gym badges. But sadly, it doesn't guarantee investing success. So just take the arguments and predictions in this report at face value and don't get too caught up with all these quote-unquote qualifications. And the only qualification I need on YouTube is the like button. So can you help me like that smash button? Thanks. Oh, I have good news by the way. So Webull has recently extended their latest sign-up bonus rewards of up to $130 worth of Tesla shares for new users until the 14th of October. So all you have to do is to sign up for a new account with the link below and deposit at least 2,000 Singapore dollars and execute one buy trade for a stock or ETF and one option. And you'll get an 8% return on investment from the sign-up rewards. So Webull prides itself on zero commission trading, so let's stop paying all the different commissions and use it to buy more Alibaba. For existing users though, feel free to get your friends to sign up using your own referral code. You can refer and win up to $6,888 worth of Apple shares. Details will be on the promotion page itself. I'm currently using Webull for my 15,000 portfolio challenge, so don't let this guaranteed deal get away. Link in the description below. Long story short, Goldman is arguing that given the rise of popularity of short-form video content, it will lead the radical change towards how people engage with commerce activities from here on. So for some context, short-form video has become the largest single time spent format in the Chinese internet space today, with more than 1 billion mobile users using Douyin, which is the China's version of TikTok, Kuaishou, and Tencent's video account within WeChat, with 60% active on a daily basis, spending minimally 120 minutes a day. 120 minutes. 600 million people times 120 minutes. That's 72 million minutes. And that's equivalent to 50,000 days worth of time spent watching girls dance. Oh wait, sorry. I mean spent watching immersive short-form video content. So just taking a look at the growth of time spent in each categories, short-form video has surpassed social networking, becoming the largest time spent format in China today. So that's probably why Meta Platforms, which is formerly known as Facebook, is feeling the heat. But I guess they are not stopping at disrupting the digital advert industry, but also taking on e-commerce as a whole as well. So based on Goldman Sachs estimates, ByteDance emerged as the largest advertising platform in 2021, beating out even Alibaba. But since they are still a private company, we should take these estimations with a grain of salt. So Goldman believes that short-form video players are becoming some sort of a funnel ecosystem in providing relevant recommendations ahead of other forms of entertainment or even shopping apps. Personally, however, I get slightly allergic whenever I see the term ecosystem. I think this description is being exploited by any Tom, Dick and Harry company just 2 years ago. And truth be told, not all ecosystems are created the same. And evidently, some are better than others. But hey, I'm keeping an open mind. So initially, short-form video players focused on live streaming, which is mostly impulsive shopping and gradually expanding into an all-purpose shelf-based shopping like your traditional e-commerce companies, and local services, recruitment, and even real estate. So essentially, this sort of short-form video content platforms are trying to build out their suite of e-commerce capabilities so as to migrate and eat up all of Alibaba's, JD's, and even Pinduoduo's market share. So my quote-unquote defense for e-commerce platforms at this juncture would be that it's close to impossible to alter the state of mind of consumers on the varying platforms, at least not yet. So it has probably become habitual whenever people wishes to shop for stuff, they will head over straight to e-commerce platforms like Amazon, Alibaba, eBay, JD, etc. And I doubt there will be scenarios where, hey, today I wish to buy a camera and I'll hop onto TikTok to browse for cameras. At least, I don't think this is happening yet. Which is also why If you're to compare to Meta's earlier efforts to push into e-commerce with live streaming and also Facebook Marketplace, there seems to be a lot of friction in the process. And I think it's largely attributable to the state of the consumer's mind on the different platforms. Of course, ByteDance could very well be able to turn this whole thing around, looking at how far they've executed thus far. I wouldn't underestimate them. So the consumer's state of mind is important because when you have the strong urge for buying things, you tend to be a lot more impressionable when served with the different e-commerce related ads, compared to ads being plastered at your face whenever you are looking at cute dog videos or just scrolling through memes or looking into what your friend is up to today. Hence, Google seems to be the only one for now that has cracked the code for being able to reach out to both types of consumers, those that are just scrolling around and also those with buying intentions. So currently, Goldman is also predicting that there will be a shift in consumers' consumption patterns where they expect live streaming e-commerce to reach 25% of online shopping in 2025 from the 15% in 2021 now. So the silver lining is, at least on an industry basis, the total GMV, which is gross merchandise value, for e-commerce in China is at around 16 trillion renminbi now, and it's expected to grow to 22 trillion renminbi in 2025. And tell me more about what a tailwind looks like. That said, however, based on Goldman's own humble estimates, Alibaba is going to be affected severely by this trend. And if the base case for short-form video content do play out based on their assumptions, Alibaba's GMV CAGR is only estimated to grow by 1%. And if the bull case for this sort of short-form video taking and beating out competition, Alibaba is going to shrink in the coming 3 years. For now at least, the consensus for Alibaba's GMV CAGR sits at around 5%. And at least for me, I'm basing my estimates closer to the consensus. So I think the biggest question for many investors out there would be, to what extent will these sort of short-form video platforms disrupt the traditional e-commerce players? So if we were to observe by categories, apparels, cosmetics, and F&B are typically the top 3 categories for live stream e-commerce, probably due to the lower ticket size nature, and live streaming can better illustrate or showcase the different products and create better interaction with the different consumers. So I think at least from Alibaba's perspective, they've already identified the live streaming e-commerce opportunity quite early on. That's why they've spent a considerable amount of resources and time in trying to build out Taobao Live since 2016. Just recently as well, Li Jiaqi, also known as China's lipstick king, reappeared on Taobao Live after a 3-month hiatus because of some sort of controversies. But let's not delve too deep into it. And Li Jiaqi's show immediately attracted thousands of viewers within the first few minutes, despite no prior notices on his social media accounts. By the end of his 2-hour show, guess how many people watched his live stream? 63 million viewers. 63 million on Taobao Live. I just don't want you to be walking away from this video thinking that the bigger players like Alibaba is just letting TikTok, Kuaishou do their own thing and eat up their lunch. So this is business we are talking about. And Alibaba is well entrenched in the live streaming ecosystem as well. That being said, I do agree that if we were to compare the typical profile of a user on these different platforms, it is actually quite obvious that these sort of short-form video platforms like TikTok is sucking up all the time spent from users, which was also why Meta is of going concern. So based on estimates, Douyin's daily active user opens the Douyin app on average 14 times a day and spend around 2 hours per day, while comparing it to Taobao, users only open it on average 6 times a day and only spend 20 minutes on it. That said, the argument is still the same. It depends on the objective of the platforms for retaining the users and how do they attempt or how do they intend to monetize from them. So does spending a longer time on the platform ensures that greater spending from the users? At least for now, the data seems to show otherwise. So the average revenue per user on Douyin is around 4,000 renminbi per month, but for Taobao, it's 9,000 renminbi per month, despite having 6 times the time spent on the platform. Secondly, the ads effectiveness of Douyin remains to be seen by advertisers. So it's largely true that a huge ton of people are spending their time on the app, but to advertisers, they are pretty much more concerned with ad effectiveness and conversion rate, because at the end of the day, it's all about sales and all about profits for different businesses. Unless they're doing some sort of an awareness campaign or something where they just want to plaster their name out there. If not, it all voices down to the dollars and cents. So ad conversion rate is probably heavily influenced by the consumer's state of mind. So I think it might be a little bit too early to make that conclusion, especially when the numbers from Douyin is kept from the public because they're not a listed entity. So I will just quickly furnish the bear, base and bull case for these short form video platforms and how it will affect Alibaba's position based on the different assumptions made by Goldman's analysts. So for now, it's based on Goldman's guesswork, and they are basically predicting that Alibaba might hold their current GMV value out into 2025. But if Alibaba doesn't grow alongside the entire e-commerce industry, their market share will fall from 50% in 2021 to a measly 39% in 2025, as the whole industry gets disrupted with this new form of e-commerce activity. So leave in the comment section down below what are your thoughts about this quote-unquote new consumption pattern of the Chinese consumers, and I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye!